What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is December 20th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are, and I hope you guys are getting excited for the holiday season. I'm excited for Christmas here and the coming days to spend some time with family and friends. But I want to go ahead and spend some time to talk about crypto markets and traditional markets today. We're going to take a look at a few different kind of measurements to understand where we are in the given cycle. Also, along with that as well, talking about a potential reversal in markets finally through our key indicators that we utilize, and along with that as well, taking a look at some key economic data as we continue to see equity markets rallying forward day by day, setting new highs here as stock buybacks have continued to fuel upside pressure on markets. All right, so we've got a lot of things to discuss. Let's go ahead and dive right into it. So taking a look here over the last 24 hours, we can see that most cryptocurrencies are in the green at the moment. I'd still say that most are trading in a kind of no trend scenario, but if I had to pick a side here, you can see the vast majority of the market's in the green here with some key plays doing quite well. Most of our trades are actually doing relatively similar. A lot of our key plays for the year, like Basic Attention Token, Chainlink, and Ravencoin, are all doing about 3-point-something%. So it's good to see. We're seeing markets recover a bit, and we're going back more towards a normalized range at around $200 billion. Again, got a few more billion to go here after the pretty stark sell-off we had, but I don't want to focus too much on the short term. We talked the other day kind of about my thesis about where we are right now, how we were overextended, but I want to take actually a broader look here, not just taking a look at Bitcoin, but talking about overall market capitalization. Then we'll dive into this topic of a potential Bitcoin reversal. So the thing I would usually use TradingView here. There is actually, you can type in total on TradingView and you will get a relatively similar statistic. But the issue is I think either they're pulling from a different API than CoinMarketCap's data. It doesn't display the time range that we have here from all the way back in 2013. So I want to go ahead and actually use this here. Now, the good news is, as much as this is a difficult chart to kind of navigate here on such a large time frame, and not to mention it's a line chart, I generally took the bottom statistics from each of these cycles. I'll start from ground one. Let me explain this better. So what I basically wanted to showcase here is how different are we performing in a similar time frame from the bottom of each market cycle. So back here, the bottom was down here. I'll get the official number here. I've already done the calculations, so I'll save us some time. But the actual number is 3,100,000,000, right? And I basically took the level where we were a year from that time. So that would be January 14th or 13th or 15th of 2016, right? So traveling over and getting that date over here, right? So I took that number, and I also took the same yearly time frame here from our bottom on December 14th, right? This is when we set the bottom for the market at around $103 billion. So I did the math, and the percentage return for this cycle back here was about 130% from the lows to that time. And over here, we had a cycle return, or it's really, we haven't started the full-scale bull market. We're in the exit of the accumulation phase. And that same period of time, we had a 93% return. So definitely not, I think, the esteemed 130% we had back here, not to mention in a market that's much smaller, and usually smaller markets, as you can take a look back at the previous price history of Bitcoin, tends to be that with every cycle there's a decay in returns. There's not going to be as great of returns as in the past. But 93% in this big of a market, when we're talking about going from 100 billion to 190 billion, and then over here we're talking about going from, doubling the market from 3 to a little over 7 billion. It's like, I mean, come on, guys. We have to understand this is a completely different scale of market, and this is amazing to see that returns are maintaining at these kind of levels. I don't think we're going to get something this crazy in the next cycle coming, a few years down the line. I mean, I think this is pretty good for performance. Now, I didn't do the measurements here on altcoins in this case, but I can just go ahead and show you we've been doing pretty well. So you can see here, for example, we had a bottom here around 389 million. This is all the way back in 2014, if what the time flies in this case. But you can also see here as well, taking about a time frame here. So we're going to August and then coming over here in this time frame, right? Had about a double here. And if we take a look down here as well, right? Down here at 45 billion, still trending around it's about $60 billion. So again, right, we're talking about 33% return in altcoins. We're not seeing as much of a leap up here. But again, it's a little bit difficult to compare altcoins because I think altcoins weren't really a developed market here. You can see that altcoins have been the best performer over the last few years. So again, I digress in this point about the overall market in this case. Market cap is going to be circulating between the two, I would say, more than anything. We're going to see a decay of returns over time, but we're still seeing good returns. And it's showcasing us that we're not too far off from where we should be in the market cycle. So just those things to provide perspective. In the sense of Bitcoin dominance, again, we've still been seeing lower highs here, Bitcoin dominance. I'll take a look at that after we talk about Bitcoin here, as we talk about a trend shift. But let's go ahead and talk about, obviously, I think what a lot of people are excited to hear about. Well, if you guys like the 3 indicators, we use the SMS strategy, basically the squeeze momentum indicator, the MACD, and the Stochastic Rsi on the weekly. Bitcoin is looking like it's very close to setting basically a 3 out of 5 or more point range for the SMS. So we have a declining divergence here on the MACD. You can see the lighter candles here. So there's a smaller spread between the two moving averages. The Stochastic RSI here on the weekly is getting very close, like it did back here. It's having both lines in the purple channel. And along with that, we've got the squeeze momentum indicator coming up here, curling up, and setting a higher level in this case, starting to, again, signal that we might be having more momentum to the upside. We can see your price, I think, has been signaling this. I mean, we obviously had a good rebound here over the last few days. And the whole objective is not to bottom chase, guys. You're never going to pick the absolute bottom. You're never going to sell the absolute top. But our indicator generally sold up here, taking profits at around 11, I think around 11 or 1,200 in this case, or sorry, 12,000. And back here as well. It's starting to flash very close. We only have 2 out of 5, but it's getting close to where next week we might be able to have a bullish reversal in this case. I would say through these lines popping up into the purple channel here. That's generally how we get points in this case for the indicator. So again, things are looking good here. I'd say the only thing that I have to say I would want to see before I got really bullish is some good resurgence in volume like we saw back here. That'd be really good. What I like to see is that the sell side volume hasn't been really crazy, right? It's just been pretty average volume. But I want to see these kind of build-ups and candles on the weekly where buyers are really coming in here on spot exchanges. And then also see follow-through on backed and futures and all kinds of different things like that. All right, so let's go ahead and take a look here at Bitcoin dominance. Now we can take a look here. There's one thing that I will say. I wanted to make sure that this is not going to close at a generally higher range here than what we saw over here. This might be a trend reversal here for Bitcoin dominance. So Bitcoin dominance might continue to go back to growing here. But again, I'm going to wait until we see a solid close here above 70, which we haven't seen just yet, right? So again, this is what I'm waiting for here. A good amount of pressure above this level to really showcase we're not setting lower highs anymore, right? It does startle me and kind of concern me a little bit being exposed into altcoins that it's this high, and it has had this kind of pressure here with the sell side. But again, we'll have to see what happens. I'm not rushing to conclusions, guys. And if we do get a close above there, I'll let you guys know if I make any adjustments to my positions. But all the momentum indicators, outside of one of the stochastic RSI lines here, the divergence here, right? We have 2 points here signaling that we might be for bullish reversal, but we haven't gotten it just yet, right? So we'll watch for that. As we watch for that in Bitcoin, we'll watch for it in altcoin dominance here because it does show relevancy. Our indicators were flashing back here that Bitcoin dominance was set for a slight decline. And we got that here. We got it on the cross in the MACD and the stochastic RSI, all really before it started to happen. Okay, so that's why I like these indicators. Now, in the sense of trades here, I just wanted to show you guys on my eToro account, there was one trade that I did make as of recent. I sold my Bitcoin position for more Ethereum. And again, this could be subject to change if we start to see the altcoin cycle start to shift. If we don't get that just yet, again, it would be different. We usually don't get the altcoin cycle this early. It just looked like on the chart that we were seeing a solid trend reversal. I positioned myself accordingly because of that. So now I'm well exposed to NEO, playing off some of the China plays. Ethereum really mostly for DeFi and the fact that I think it's excessively oversold to Bitcoin. And along with that as well, Litecoin. In this case, if we take a look at the Litecoin to Bitcoin ratio, very similar to the gold to silver ratio. In this case, Litecoin is actually relatively cheap, historically speaking, but who knows, it might stay down there for a while. One thing I wanted to mention as well, I know I've talked about it before, but I just want to let you guys know it's the holiday season. I'm also a part of this. It's basically the Altcoin Fantasy charity event. They're doing a charity event that's helping to donate to Shriners Hospital, Ocean Conservancy, Trees for the Future, and Binance Charity. And they're giving away a lot of great prizes, right? You have all these different prizes here from winning a few $100 and Bitcoin and hotel stays. And along with that as well, you have a lot of different donation prizes here, from Trader Cobb to TaxBit and Pillar, and as well as TrueUSD giving away some gifts. But these are the sponsors here who have donated and want to give them a big shout out. And these are the big charities that we're helping to support. Trees for the Future is one of my favorites. But there's a lot of great organizations. I like all of them personally. And again, if you guys want to make a small donation, or if you just want to enter into the contest, feel free to check out the link down below. All right. So I got to say, guys, this is a day to celebrate. I know it seems so quirky and nerdy for me to get excited about this, but Yardeni Research finally, after having Q3 data on dividends forever, because Q3 has been over for a while, we finally got Q3 stock buyback data plugged in. Finally. Now, I have to say, I'm actually a bit surprised here. I have to say that I've been a little bit, I'm in awe. I've been thrown back by my previous expectations, because I was expecting we would follow a very similar trend here to what we saw back in 2007, where when stock buybacks started to decline as steady as they did from back here in Q1 to Q2, we actually saw a little bit of a bump up back in Q3. And this actually explains a lot of why the market has performed the way it has. Stock buybacks, I think, have maintained higher than what people expected. Corporate earnings were actually not too bad back in this last quarter. So it makes relatively decent sense. And when you've got over here as well, the dividends, in this case, coming back to investors, going likely into drip programs, both of these provide buy-side pressure for markets. It's continuous buyers who are coming in and paying these prices and not really guessing the otherwise in this case, because companies see stock buybacks as a value add. People who are putting into drip programs, they're trying to compound their investments so their dividends pay out even more, right? So I'm very surprised here to actually see this. Well, I'm not too shocked, but this is definitely, I definitely thought we'd still set a lower level here. But the one thing that I would want to talk about is a question of whether or not this is going to maintain. Are we going to still be able to hold at this range, or is the average, like back here in 2007, going to start declining? Well, it really all depends on what we talked about earlier, which is corporate earnings. So Goldman Sachs came out back a few days ago and basically believed that stock buybacks are going to see a 15% dip. And because of this, they're warning equities could suffer if the trend gains steam in this case. If you start to see less companies buying back their own shares with their available cash, or worse off, taking out loan positions in this case to buy up stock, meaning that they're not really likely finding value at that range to purchase their own shares, in that case, prices are going to go down. It has been the biggest net buyer of stocks over the last decade. Corporate purchases in this case, non-financial corporation purchases of equities has been the biggest inflow by far. Retail traders, pretty much neutral since 2008. Hedge funds, relatively neutral. There's been foreign money into the United States because money has wanted to leave other markets ever since the tax cuts and the deregulation and the easing of monetary policy in the U.S. and the strong dollar. But along with that as well, we have seen just plainly in this case companies buying up either their own shares or other shares. So this is a key thing to take into mind here. It's going to be a matter of corporate earnings. And I would say that a 15% dip would actually not be that instrumentally detrimental to equity markets. I'd just say it's not going to have as much upside pressure. When we see it dropping down to this range where we're getting nearly half of what we used to, say 400 billion, 300 billion, and prices are getting higher, so the sell side pressure is even greater, yeah, that's going to have me concerned. That's when I start to get worried. And that's exactly when price really started to dip here going into the later part of 2007 and early part of 2008. So that's what we're going to be looking for here. Now, I want to take a look here at LMTR. They've got a few interesting charts. And speaking of companies possibly taking out cash to take riskier ventures, well, we can basically talk about the leveraged loan market. So you guys know, for example, if you've ever, if you study 2008 or if you've just simply watched The Big Short, you guys probably know that there are different ratings on bonds in this case. There's different ratings on debt, right? And we've got, the Bs, the triple Bs, the As, the triple As. There's all these different ratings in this case. Basically, the higher you are to A, and the larger amount of A's that you have, it's basically a high rating bond. It's secure. And these rating agencies, like Standard & Poor's in this case, basically do all these assessments of different products in this case, different financial products. They is this a credit-worthy product in this case? Are the people behind these bonds, whether they're mortgages, whether it's corporate bonds, are they people who are reliable? Do they have good cash on their balance sheet? Do they have good credit? Are they reliable? Have we seen in the past? Is this a safe investment that's probably going to pay a lower return, or is it a riskier investment that's going to have to pay a higher yield, right? Where there's more likelihood of default? Well, that's how the ratings work in this case, right? The closer you are to Bs, the higher the risk. Well, we have seen the credit rating agencies have not changed their ways. Back in 2008, they marked a lot of things, basically the mortgage-backed securities, as much higher rating in the sense of creditworthiness than they were. They put them into a tranche that was not fitting. They lied. And the reason why they did that is because they had every incentive to do it. Because the rating agencies benefit when they give ratings, in this case, to financial products, right? They can actually have a net win in this case. They can make money by giving improper ratings, in this case, to different types of assets. So down here, this paragraph, it summarizes it really well. We should add that there's a simple reason that rating agencies are willing to give BBB ratings to what are really junk bonds. And this is the problem we'll lead into. The answer is greed. They are paid by the principals involved in a bond offering who can always go to a competitor if they are not happy. Meanwhile, unfortunately, investment professionals often foolishly take oversized risks to maximize returns. This is the issue. It's misaligned incentive structures, and we're repeating the same stuff because we never really built a foundation to change the incentive structures. If I have an incentive as an employee, not as an organization, as an employee, if I get sign-up bonuses or I get bonuses for how much financial products I give ratings to in this case, and I know that people are going to go to another rating agency unless I give them a better rating than I should, then heck, if I'm a scummy person and I only care about being there for 5-6 years, making a big bonus and then going to retire in the Cayman Islands, yeah, I'm going to do it. That's exactly what anyone would do, I would say, in that case, if you really didn't have a sense of moral ethics. I know I personally wouldn't. The basic thing here is that incentive structure doesn't matter if you or I would. There's a bunch of people who will, and even if 20-30% do it, you've just set a hole in the economy by having 20 or 30% of people who don't have that moral or ethical lining to basically go through and give false ratings to potentially trillions of dollars of assets. And that's the problem here. There's an issue now in the leveraged loan market where now more assets are getting a B rating in this case that really should be B minus. They should be really toxic junk bond assets that people should understand are much higher risk. So it's the same exact problems here. It's slapping a label on something that's not truthful. It's not real. It's not as secure as it is. And that's the problem here is that, we have this kind of false mentality that in the economy right now, and I'm talking not about equity markets. Equity markets are going to continue to rally with stock buybacks. In the underlying economy, it's been this way for the last few decades. People are taking on more and more debt. People's creditworthiness, though it might have improved maybe since 2008, the issue here is that you get into the point where there is too much credit, and when that lever gets pulled, right, you stop having new stimulation of new credit to pay down previous credit, and basically once you stop injecting money and you start removing capital from the system, you start making interest rates higher, which makes it more difficult to borrow capital. You start to realize that those ratings you gave them are likely not truthful. Okay, so that's the major thing I wanted to talk about here. There's a few other charts here on LMTR. They also took a really interesting perspective from one of their close friends at Sentiment Trader. Basically, there's a fund called Ridex. And Ridex is a family of mutual funds in this case. Of course, mutual funds are losing. I think they're losing their importance in the world. But showcasing here basically the days of popularity here where traders have never been more bullish. So you can see here we basically are pressing back up here towards 100%. We're going near parabolic here, guys. And it's a sign that we're likely getting towards the later phases of this market. We're getting that 25% leap up that we've gotten this year since the inversion of the yield curve. It happens historically, right? We talked about, again, when the inversion of the yield curve happened, a lot of people were like, oh my God, this means the market's going to collapse today. And now people have forgotten about it because it didn't. Well, that's not how it works. The inversion of the yield curve is a precursor. It's an early warning sign to something to come in this case. And it's showing that there is a sense of inefficiency in the sense of treasury markets and debt. And because of this, it's a good sign in this case that people are taking, in this case, to kind of explain the spread a little bit, if I word it correctly, basically people are paying generally the same rate they would on treasuries in this case or government bonds in the short term as they would in the long term, right? And that's not a normal thing to see, right? So we're basically seeing here again equities continuing to go up in this case, and this is again that 25%, about 20-25% margin we historically see after the inversion of the yield curve. So do we have much more to go? I don't know. If the Fed keeps printing money, I don't see why not, so long as they can maintain more inflows than outflows. But a lot of little interesting indicators here from their general ratio, their money markets exposure, pretty much nothing. The bull to bear ratio, riding up towards near all-time highs, and the Ridex leverage bull to bear ratio. So a lot of people are leveraged to the bull side here, right? Really interesting stuff. Very similar signals to what we saw in previous cycles. Okay. All right. Last thing I want to talk about is the housing market. Now, the housing market, I got to be fair, on the surface level has not shown any sign of decline, and until then, we're not going to be bearish on it. As much as I was concerned if we started to stagnate here back a few months ago towards 2018, we're still climbing up here. We just saw it pop back up near the percentage growth we had back here at the beginning quarter of 2018, right? So the housing market's still growing, and this is for especially for new housing permits, right? There's still a lot of residential developments. The key thing to take in mind, though, is if you were to build a channel between the highs here and the lows, a general channel here, or a general trend, we are heading towards the upper band here. We're basically heading towards resistance in the next year or two, right? Could happen sooner than later. Could happen a little bit later. Who knows? We could defy the odds and keep growing through. Doesn't mean that this has to follow a specific channel. You can see the highs and lows are a little bit wonky. But the fact of the matter is, in the sense of the overall trend here, we're on the upper band. We're on the later phases here of the housing market. So what we're watching for now is a clear sign of a top, where for a quarter or two, we really start to see steady declines here. But we haven't seen that yet. So because of that, I'm not getting too crazy, or I'm not going to be too bearish. And not to mention as well, the growth rate is going to decline over time for two reasons, or at least this is what I could assess. Maybe there's more that you guys can think of. I would say declining population growth in the United States. People are having less families, and along with that as well, in the United States, of course, as you're growing as a country, it's more difficult in this case to, well, I would say actually, I don't want to say it. I don't want to talk out of my butt, but basically, you're not going to have, I think, as much of a growth here in this case if you have a declining population, but also you have a larger country and less people now are buying their own homes. They're not taking out these mortgages, and they're probably sticking with, staying with their parents, things of that sort. So I would say that's probably more my second reason, because honestly, growth, if population is growing at 1 or 2%, and it stays continuous at that rate, housing demand should be relatively the same, right? Well, I'd say, this was the reason. Because the growth rate on top of that is probably going to shrink over time. Even if you maintain 1 or 2% population growth, right, overall sales are not going to grow in this case, right? You see what I'm saying? Like, new housing permits are not going to grow at the same rates they used to, right? So anyways, sorry, that was my point. Because you can probably tell I have not had, I don't drink coffee or tea, but I've been actually drinking Tereré, which is this new stuff I found out of Paraguay for my recent trip, which I'm excited to share with you guys. That video is going to come out on Monday. But it's my favorite new drink. It doesn't have as much caffeine, and it's something that's just it's just very mild. You don't get any kind of like I guess not only do you not get jittery, but you also don't have that kind of spike that you get with caffeine and stuff, where you have like a really big buzz and then you kind of crash in that case. I don't like that, and it's just caffeine usually messes me up in most cases. But in this case, it's a great drink and it tastes really good. It reminds me a lot of tea. But anyways, I've rambled on enough today, guys. I hope you're having a fantastic day wherever you guys are, and we'll probably have a video up here in the next few days. If not, we're going to probably put the video out on Monday for the trip that I took to Paraguay. I'm so excited to share that with you guys. It was a really good trip that I took. But until then, I hope you guys are having a fantastic day wherever you are, and I hope you all enjoy the holiday season as well. I'll talk to you all soon.